Coming to the global economy, China is the biggest contributing factor in terms of incremental growth. A large part of Chinese growth is driven by debt. And if we go by prior experiences of Japan, which was at one point of time leading economy, Asian tiger economies, or US, they all somewhere around between 175 to 200% debt to GDP ratio started stagnating. China is reaching nearer those peaks. Going forward, will there be slowdown in China, or will it defy the trend? Will determine what happens globally. The Chinese growth is driven by huge amount of credit. And when you are lending so fast, undoubtedly NPAs increase. There is a new term in the market called involution. आज तक स्कूल या कॉलेज में हमने ये कभी पढ़ा नहीं था. मार्केट में भी ये नहीं पढ़ा था. But apparently when you have excess capacity and you try to shut down those excess capacity, it is called involution. There is a saying which says that Rome wasn't built in a day, but China actually is building Rome every day. They are consuming more cement every day than what was used in constructing Rome. Now, with that kind of excessive capacity, China is trying to shut down some capacity, and this is known as involution. This involution is visible in terms of drop in the plant and machinery and equipment purchases. It is also reflected in shift of manufacturing. This is where China scores very well. They start in low value add item like chemicals, hardware, computer hardware, and eventually they move towards higher value add. Apart from China, globally, manufacturing PMI has improved a little bit after a phase of negative run-in. Yet 2025 global GDP growth will be subdued. 2026 will be better, subject to President Trump. More importantly, growth is varying across various countries. Countries like Germany, Italy, whole of Europe is witnessing fairly subdued growth. Compared to them, France, Japan, US are seeing better growth. Because of this variation in growth and different policy, we have seen equity market across the world and debt market across the world moving in random direction. Coming to US economy, well, there is tariff war going on. President Trump every day is levying different tariff on different countries. India, Brazil has been clubbed in the range of 50% tariff. Thanks to AI-related investment, second quarter GDP growth of US came fairly ahead of expectation. This is reflected in their numbers. The big 7 companies' investment has started picking up. And government continues to play large part in American economy. In the wartime, government was almost little below half of economy. In peacetime also, now American government is little under half of American economy. Many a times Western economists have taught government has no business to be in government or business. Unfortunately, in US, they are not adhering to that advice. Some signs of distress are visible in US in terms of rising bankruptcy. Of course, they are nowhere near crisis time like 2008-9, but they are rising compared to previous years. Unemployment, especially for the young adults in the age group of 16 to 24, seems to be rising. The deficit continues to remain high. Debt continues to climb up. America has the largest, highest debt in the world. The real question is, by imposing tariff, does America benefit or does America lose? Goldman Sachs believes that ultimately tariff burden will be borne by US consumer. When a TV host raised that question to Scott Bessent, Treasury Secretary, he vehemently denied that and in fact made a comment, I have made more money betting against Goldman, so please don't trust him. The experience of tariff globally is that ultimately it is consumer who pays tariff. Time will tell whether there is exception for America or not, whether Goldman Sachs is right or whether Treasury Secretary is correct. Apart from that, a lot of foreign money is invested into American equities, treasuries, corporate debt. These numbers run into trillions of dollars. And if this money moves out, all those assets could come under pressure. Thanks to the unpredictable behavior of US politics, the dollar has weakened by about 10% vis-a-vis major currencies. Euro, Great Britain, pound, both have appreciated significantly against dollar. The tariff levied on India is absolutely unreasonable and unfair. The largest buyer of Russian coal is China. The largest buyer of Russian crude oil is China. The largest buyer of LNG and piped gas from Russia is European Union. India does import some oil from Russia. It has gone up pre-sanction days, but we are buying those oil at a price cap decided by the global leaders. We are complying with the price cap and buying Russian oil, which is in absolute compliance with what sanctions approve. China buys oil from Iran in violation of sanctions. China buys rare earths from Myanmar in violation of sanctions. It supports North Korea in violation of sanctions. And yet, America has no courage to take on China. Coming to Indian economy, the growth number for first quarter came at 7.8%, way ahead of everyone's expectation. Overall headlines, by and large, has been positive for Indian economy. The GDP growth at 7.8% for June 25 quarter was way ahead of market expectation. It was driven by increase in government spending, which on a rolling 6-month basis was at record high. Many a times people doubt whether GDP growth is real or not, and which is where we did this comparison. From 1990, our GDP is up about 12 times. IT exports are up about 1,500 times because in 1990, we had very, very small base. Air passengers are up about 21 times. Two-wheeler and car production is also up significantly. Obviously, agriculture production is not up as much as industrial production because population itself is up just about 1.7 times. When we look at these numbers, it does give confirmation that India has grown from 1990 base. We were Dabba or coach to the global growth train. Now we are becoming engine of global growth train. पहले दुनिया चलती थी तो हम चलते थे, अब हम चलेंगे तो दुनिया चलेगी. Of course, global growth train has 3 engines: China number 1, India number 2, and US number 3. All this growth has been achieved on fiscal prudence. No parents wants to live debt on their kids. Unfortunately, all governments borrow money and put burden on their next generation. India is the only country in the world who has reduced debt to GDP ratio between subprime crisis in 2008 and post-COVID era in 2025. Government of India obviously has borrowed money to fund COVID expenditure, but households and corporate India has deleveraged. This is the reason why India is getting re-rated. The poor standard company also accepted that India deserves a rating upgrade. We were borrowing at 6% higher than American 10-year yield in 2014. Today, we are borrowing at about 2% higher than 10-year American yield. Rating agencies have upgraded India after a pause of 18 years. This chart shows that there will be many states in future in India who will become as big as yesterday's India. In 2035, Maharashtra should be about $1 trillion economy. Not so long ago, India was about $1 trillion economy. This growth obviously will come for satisfying domestic demand as well as becoming export powerhouse. No country has grown without exports. And if we have to go 7 times in our journey, the sectors of the future, from semiconductors to robotics to biopharma, will contribute substantial part. Rain gods have been kind to India. In deserts, there is excess rain. Where there is river, there is little bit deficiency. Overall, it is one of the best distribution of rain. Water reservoirs are higher than last 10-year average. Kharif sowing should result into bumper crop this year. The omens are good for Rabi crop. Rural consumption, thanks to good agriculture, is doing well. but we have now started seeing revival in urban consumption. The government is working to provide stimulus to domestic economy to ward off adverse impact of tariff. पहले इनकम टैक्स रिलीफ दिया 1 लाख करोड़ का. Now GST relief is 50,000 crore this year, and next year 1 lakh crore. Eighth pay commission will put about $55 billion in the pockets of government employees, and all state governments facing election will announce Ladli Behna, Ladla Bhaiya schemes. The GST rationalization obviously will cost 50,000 crore this year. But with the pickup in consumption, government believes some of those shortfalls will be bridged. The capacity utilization for India Inc. remains in the higher ranges of 75% around. Crude prices continue to remain favorable to India. Our challenge remains almost $100 billion trade deficit with India, with China. No wonder Prime Minister is talking about Swadeshi. Singapore runs trade surplus with most countries around the world, but they are in deficit with US. India is the second largest trade deficit after US in the world at $250 billion. But we run $100 billion trade deficit with China, $60 billion trade deficit with Russia, and $40 billion trade surplus with America. After running second largest trade deficit in the world, we found only country with whom we want to run large trade surplus was America. The one warning signal is GST collection. April to June quarter GST collection came well below nominal GDP target for this year. July, August were no different. This shows that despite record first quarter GDP growth of 7.8, absence of inflation or pricing is resulting into lower tax collection. To some extent, IT sector has not created jobs, and they were normally creating well-paying jobs, absorbing engineering talent. This could be the reason why GST collection growth is subdued. There will be adverse impact of American tariff on India. At first, 25% tariff, we could have still managed because our competitors were getting 19-20% tariff. 5-6% was manageable. But at 50% tariff, it is an embargo. It's no longer tariff. This tariff's adverse impact will be felt more in sectors like textiles, aquaculture. It will be felt little less in some of the sectors where we have niche, for example, pharmaceuticals or chemicals. But undoubtedly, higher tariff will have adverse impact on India's growth in the near term. These are some of the sectors and details how US tariff is likely to impact us. I'll recommend all of you to please read through them at leisure. The best option for India is to diversify exports into other markets. Easier said than done. But I believe by stimulating domestic economy, by shifting exports to other countries, and by providing some credit facility, we should be able to minimize adverse impact of Trump tariff. If we look at the data, thanks to our students studying in America, thanks to all of us traveling to America, and thanks to all of us using WhatsApp, Facebook, etc., the American and India trade is reasonably well balanced. The Max 7 earns a lot of money from India, which probably Trump administration is not acknowledging. In Boston, there was a revolt when tariffs were levied on tea. So in the American history, tariffs have resulted into protest and opposition. They cannot expect non-retaliation from other countries. Another fear for us is the state election. Bihar election is round the corner. How much freebies will be distributed? If freebies take away large part of the budget, there will be less money for investment to build infrastructure. That will reduce long-term growth potential, and that will result into immediate derating of the market. Coming to equity markets, market cap to GDP ratio remains elevated. Our share in global market cap is in line with our share in global GDP. Large cap, mid cap continues to trade around historical valuation. Small cap continues to trade at premium to historical valuation. If we look at the results, by and large, results were in line with expectation. The Nifty universe delivered about high single-digit growth. The disappointment was in small cap, where against expectation of 5% growth, actual number came at 7% degrowth, a 12% diversion. More importantly, volume growth was subdued across the board. The profit growth of about 8% was driven by margin and by leverage. Overall, India Inc. continues to maintain high profitability to GDP ratio. Our return on equity is much higher than many of our peers. Our ROE differential over emerging market is little above historical average, but still within manageable distance. Our premium to emerging market is coming to long-term average as large cap moves from expensive zone to buy zone. Our earnings growth will narrow down vis-a-vis peer group as base has expanded. Domestic investors continue to buy into every market situation. There is fair amount of IPO and QIP and OFS supply coming and hitting the market. And FPIs also continue to be a seller. Collectively, I will say our markets is tilted in favor of buyers as there is fair amount of supply pressure from FPIs, promoters, and corporates doing capital market listing. This is the comparison between FPIs, overweight, underweight, vis-a-vis mutual fund. There are areas where we are opposed to each other. There are areas where our views remain the same. FPIs now own little under 16% of total market cap. It is as low as it was in 2012. Undoubtedly, they have got exit. Will they now come back? One factor which will support FPI's investment into equity market is relative positioning of emerging market and developed market. There are periods where emerging market does well, and there are periods where it doesn't. The current balance is in favor of emerging market, as for almost 15 years, it hasn't outperformed American markets. Stocks have delivered return over last 5 years. Many of them are trading at expensive valuation. Like there are about 7 companies which was trading above 500p in August 2025. Today, there was one company trading at 500p in 2020. Today, there are 7 companies trading at that high valuation. Overall, last 5 years return driven by small and mid cap was pretty good at 16%. But 15 years before, large and mid cap delivered almost all the return for the investors. If people are going to invest expecting 20% to make, they are likely to be disappointed. If you are going to invest with this kind of expectation, it's probably lying to materialize. Overall, we believe we are in a very, very delicate situation. Fundamentally, we are good, but sentimentally, everything will be decided by President Trump in the near term. Our view remains unchanged on equity, neutral allocation. Don't take too much risk. Don't avoid risk. Be overweight large cap and be marginally underweight mid and small cap. On the equity investment opportunity, our funds continue to add value to the customers on a rolling return basis. They add value on a point-to-point basis. They add value on systematic investment plan. As you have seen over the years, the SIPs have added tremendous value to customers. And hopefully, going forward, this trend should continue. One of our fund worth considering is Kotak Business Cycle Fund. It is just under 3 years in terms of existence, and it has generated better return than benchmark index. It's able to move from one sector to another sector depending upon theme liked by the fund manager. The other fund is Kotak Pioneer Fund. Again, stellar track record over 5 years. It can invest in overseas companies or ETFs. On the passive side, we have now created portfolio of many low-cost fund. They are one of the lowest expenses fund in the industry. We have portfolio across thematic, offshore, retail, HNI, all kind of index available. At this point of time, these are the funds which we believe will be appropriate to consider on the passive portfolio side. Coming to debt market, currencies have moved all over the world. Europe, GBP, even yen has appreciated against dollar as dollar index came down by about 10%. US inflation, despite all the worry, remains well under control. Fed now is expected to cut rates starting this month, about 3 to 4 rate cuts by the time the Fed is expected to cut 3 to 4 this year till such time President Trump appoints new chairman. One noticeable change is the increase in 30-year bond yields. In India itself, 30-year bond moved from 703 to 731, 28 basis point, wiping out last 6 months return on the duration fund. Inflation continues to remain well behaved in India, and there is chances that actual inflation could be even lower than what RBI estimated in its credit policy. RBI has pumped ample liquidity into system by buying government securities, doing open market operations, and cutting CRR. They have taken enough number of steps to support growth from liquidity and rate cut point of view. However, all the policy rate cut by RBI has not necessarily resulted in lowering market rates. In fact, 10-year yield has backed up, moved up despite 50 basis point rate cut. Bond market believes while there is need to bring down short-term rates, the mid and long-term continues to be looking risky. In that scenario, default rates in CRISIL ratings have come down dramatically. It shows corporate India now is in a better health. On the debt side, income and arbitrage, Omni fund of fund is very attractive for people who are in higher tax bracket. This fund has risk return profile of a debt fund, but it has taxation advantage of an equity fund. Hybrid funds are something which one can consider for investment. There are periods where hybrid funds returns may look little lower, but if you give little time horizon, then hybrid fund starts delivering better result. Coming to gold, last 4 years have been crazy. Now, central banks hold more gold vis-a-vis US Treasury. Undoubtedly, US dollar assets are more than the gold because outside of US Treasury, central banks do deposit with Fed. They also go and buy other instruments in the market. So it's not that US dollar assets have been lower than the gold holding, but US Treasury is lower than the gold holding. The central banks are accumulating across the board, trying to their their FX reserves. And it looks like this buying of gold by central bankers should continue. America has about 8,000 tons of gold. China is officially at 2,600 tons. They buy on an average 450 to 500 tons of gold. If China wants to be ahead of America in terms of gold holding at central bank level, they'll have to continue to buy gold for 10 years at $500, 500 ton a year. Obviously, lured by the rally in precious metal prices, people have gone and pumped money in gold ETFs and silver ETFs, and both have moved forward in giving return to investors. On a valuation point of view, gold vis-a-vis oil, gold vis-a-vis equity does look expensive, but who knows whether gold is expensive or equity is cheaper. The only risk in gold is a lab-grown gold. Today, natural diamonds are at their lifetime low prices. Can something similar happen in gold? A fusion energy startup is making claim that they will be able to produce gold from mercury. This is what a lot of people have been researching upon. Till such time this doesn't become reality, we believe gold rally will continue. More importantly, India is now considering pension funds to invest in gold ETF. I was part of this committee. Silver, after a massive correction in the 80s driven by Hunt brothers, is now reaching all-time high levels. Saudi Central Bank have bought silver ETF, and if this activity is part of their core portfolio, then we will see even silver prices increasing rapidly like gold.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.